Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Hey everybody, welcome back to the Travillian Next podcast. I'm your host today, Mike Perito, head of bank strategy at Travillian Group. I am very excited to have Catherine Mealor from KBW join us today. Catherine, former colleague and friend of mine, has been covering the Southeast banks at KBW for 20 plus years. One of the most experienced and best minds joining us. So Catherine, welcome.
Thanks, I'm glad to be here. Don't age me, Mike. 20 years feels like a long time.
Oh, yeah. Well, time flies when you're having fun, right?
Yes, it does.
So, Catherine, KBW's been busy. You guys put out two pretty differentiated research reports in the last couple of weeks, you and your colleagues. One was a spotlight report around how lowering rates could impact the banking industry, and then the second was your quarterly preview for the third quarter. So, a lot for us to unpack here. Maybe just starting with a big picture question first. How would you say sentiment on the group is today or has shifted since that 50 basis point rate cut, if at all?
Yeah, if you think about this whole year has been about when the Fed was going to start to cut. If you remember, just this past summer, we were still talking about higher for longer stocks and weren't totally convinced we were going to get a rate cut later this year. So it's been a quick move. But I think what was important about the September meeting was we actually finally officially transitioned into an easing cycle. There was a lot of debate leading up to that, whether it was going to be 25 or 50. So I think 50 was somewhat of a surprise. And so so now that we're here and we're in it, you've definitely seen an investor shift towards talking more about the liability sensitive banks. I think investors want exposure to banks that can do well in a rate cutting environment. But I would say we haven't fully moved there yet. I think the jobs number we had last week, was a surprise. And I think that took another 50 bip off the table. I think that kind of showed that this is going to be really data dependent, and you don't want to go all into only liability sensitive banks because I think there's still going to be a lot of volatility as we move through the next couple of years. And so I think there's still a little bit of hesitancy with investors to go all in on banks, all in on liability sensitivity. But I will say conversations have picked up dramatically since mid-September on the topic and in general.
And maybe a good segue is, can you just remind us where kind of KBW is positioned on the small and mid-cap banks today from a rating perspective and why?
Yeah, we're still neutral. We put out this report, which you just mentioned, which talked a lot about NII growth from today into all the way through 2026. And it actually paints a really good picture for banks. We have 8% EPS growth for banks in 2025, another 12 in 2026. This is after 2 years of EPS declines. So, we still think credit is really benign. We feel good about NII trajectory. Mortgage is going to be rebounding. So it paints a really positive picture for the banks. And the first question we got from our desk when we were presenting it was, why aren't you upgrading the group? And I think a lot of it is, I still think, we are a lot closer to feeling better about the group overall. But, we still have some anxiety about credit. We haven't really felt the credit cycle. We still have some uncertainty about loan growth and deposit growth and actually NII growth. I think we're going to have a good third quarter, but then we're going to probably pull back for a couple of quarters in NII growth until we can really start to rebound in 25 and 26. And, we've been underwriting some of our stocks. We've been talking about EPS growth and profitability in 26 and even 27. And we've got investors asking us, you're asking me to underwrite this stock to 2027? I'm not there yet. I'm nervous about 3Q24. So I think we're closer. But I think before we upgrade the group and kind of move to an overweight position overall, I think we want a lot more confidence and clarity that this kind of double-digit EPS and NII per share growth that we think we're going to see is actually here and close, and there's not a lot of risk to that. Before we get there, it's just a lot of stock picking. I think we still are upgrading more stocks than downgrading, so that's good. But we're really trying to be more tactical than just having an overall overweight on the group right now.
Yeah, that makes sense, and a lot to unpack there. I want to circle back to a few different things, but first, in the third quarter bank preview that you guys put out, I thought there was a great question posed, and I'll try to summarize it. But it was essentially, assuming third quarter earnings are what they are. I imagine they're going to be choppy based on the conversations I'm having with executives across the industry. But do you expect investors to react to the third quarter earnings themselves, or do you think that the focus will kind of shift more to the narrative of improving earnings growth in 2025?
Yeah, I've had a full day of marketing in Chicago yesterday, and that was one question we asked in every meeting was, all right, we were all expecting a pretty, I would say, okay third quarter. It's going to be more about the guide to fourth quarter in 25. And I think generally we're prepared for pretty soft guides, especially into fourth quarter. And that a lot of that's just coming from growth and just the initial impact of NII headwinds as we get lower rates and the impact on loan portfolios we'll see before you can get offsetting deposit betas. And so the question was, all right, so are we going to buy on the dip, or are we going to push the shorts or the underperformance at these moments? And that was a big debate. I think watching the positioning and watching the performance of the first couple of banks that come out this next week is going to show us where investors are and how we're going to react to that. But I think third quarter, I think, is fine. The rate change happened so late in the quarter that I feel like you're not going to see a lot of earnings misses or kind of change in what we expect to see this quarter. The big focus, I think, from a near-term perspective is what's going to happen in fourth quarter and then first quarter, because we do think we're going to see NII and NIM still inflect higher this quarter, but then we're going to see them fall in the fourth quarter and the first quarter until we can really get deposit betas to catch up to lower loan pricing and then move into another inflection in NII as we get to 25. Part of why we wrote this report was to help investors look through the next 2 quarters and really stack pick over 25 and 26 earnings trajectory. So that's where we're trying to get everybody on board. But I think there's going to be a lot of volatility in the next couple of quarters while we get that and we get new guidance for 2025 and compare that to where the street is. And once that shakes out, I think there'll be less volatility in these individual quarters.
Yeah, it's interesting, and obviously, and thank you for touching on kind of third quarter expectations there a little bit. I mean, it sounds like you expect, kind of continued margin trends that we saw in the second quarter, credit up and down depending on the bank, but generally nothing kind of institutional or industry wide. One thing I think that we don't really talk a ton about is, particularly in your geography, right, with the Southeast banks, right? Like, things are best when there's a lot of confidence in asset growth and profitable asset growth. And, I don't know that anyone's had a great answer yet for what the next phase of that growth for the small and mid cap banks is going to look like, right? Is it CRE again? Like, do we just kind of roll right back into that? Is it kind of more C&I or specialty lending type growth stories that start to see re-rate? I mean, do you have any thoughts, even if you want to make them like kind of region specific, about what the next phase of kind of profitable growth might look like, which typically, at least in my experience, is kind of a one of the prereqs for seeing these valuations kind of switch back to PE and expand?
I think it's something we're really worried about. I mean, if you talk to any bank in the Southeast, typically we enjoy really nice growth rates down here in the Southeast. And, even a lot of my banks this quarter have been saying the back half of this year is just going to be really slow. There's just not a lot of demand. I do think lower rates is going to help that, but there's just not a lot of demand. So there's a lot of hope for growth to improve next year. And I think you'll see it in CRE. I think you'll see it in C&I. So I think there's, market share takeaway is generally and I'm a regional bank analyst, the large is different, but for regional banks, we just grow partly from GDP and partly from taking market share. I think we can get back to that next year, especially with lower rates. But I do think we talk a lot about kind of an air pocket of growth with CRE and construction that might happen in early next year. So you start to get lower rates. That should accelerate pay downs until we can really start to get the origination volume back up. You might see kind of an air pocket in growth in the early part of 25 until the second half of 25, where you might see improving in growth. So we talk about that a lot too. But I think generally a lot of anxiety and caution on growth in the next couple of quarters and more optimism as you get into 25. And for KBW, we expect about 4% growth for 25 for next year. So I would hardly call that, a high growth environment. So if, things really do improve, there is some upside there, but I think we've been cautious appropriately.
Yeah. And so maybe just taking a step back from everything you've laid out so far, you mentioned the 8% and 12% median EPS growth expectation in 2025 and 2026 for the KBW covered small and mid-cap banks. Assuming your rate cut expectations are accurate, which, correct me if I'm wrong, but I believe I read were 100 basis points total in 24, 100 basis points total in 25, and then 50 in the first half of 2026.
That's right.
Obviously that will move around with sentiment and the data, but assuming that's right, what do you think the biggest risk to your EPS numbers are today? Is it growth? Is it credit? Is it something else? Capital? What are your thoughts?
I think growth is first. I think that's the biggest part of as we've looked at 25 EPS. If you even remember, if we came out of the trauma of 23, I feel like then we called 2024 this transitional year, and we called 2024 this transitional year, and then 2025 was going to be better. I worry a little bit that 2025 is going to be another transitional year where you don't see growth actually pick up again until the back half of the year, and that's partly why we're rolling out 26 and we're kind of looking at 26. So I have a little bit of anxiety about that. So I think growth is a big piece of risk to estimates next year. We've only got 25-ish basis points of provisions in 25. And so if there's any change in the credit dynamics, I think that's a risk. So far we're not hearing anything negative on credit besides, office and some idiosyncratic things here and there. But really, credit's been really strong. So I would call that a risk. I think deposit betas too is a big thing that we talk a lot about. And, the interest bearing cumulative deposit beta in the tightening cycle was 55% for our banks. We're on average modeling a 40% beta on the way down through 25 and then 44 in 26. So it feels like we're being relatively conservative relative to the tightening cycle, but I don't know. We were really wrong in 2023. And so, I believe that banks are going to be able to push deposits costs down quickly. We've heard a lot of banks say that because there's the timing of each interest rate cycle, we're so close to each other. We haven't actually given customers, enough time to kind of get comfortable with these higher rates. And so just, it was not too long ago that we were raising rates. And so because it's not, because that wasn't so long ago, we'll be able to kind of lower it on the way down pretty aggressively. And a lot of banks have a lot of deposit products that are directly tied to Fed funds. And everyone kind of talks a big game on lowering deposit costs effectively. But I just have a little bit of anxiety about that because I don't know. And we didn't know last time and we were wrong. And so I think
I'm right with you.
Deposits are going to be a big thing to watch over the next couple of quarters.
I think it's impossible to know how customers are going to react, what they're going to be okay with. One thing I've been looking for is just banks where it's a bit more contractual, whether it's indexed. Some of the BaaS banks that have really seen their valuations come down, they have a lot of contractual reductions as Fed funds move down, broker deposits, things that will come and reprice and kind of automatically reprice lower. That's attractive, and a lot of those banks are, trading at discounted valuations just for various reasons. But that's a huge wild card to me. And it's going to be really difficult to forecast. So on that point, in the preview I saw, you guys are forecasting a 5% quarterly unannualized growth rate in tangible book value in the third quarter. If you would tell me there was a group anchored sub 150 of growing tangible book value double digits for the next 2 years, I would be like, sounds pretty good. How much does it matter? Because there was a weird ebb and flow on the way down, right? At first, we were all kind of guilty of saying, it's just like accounting noise, it doesn't matter. But then it got to a point where it was like, okay, this really matters. So on the way back up now, how much do you think it will matter? Or does it get to a point where the shift just is so much on the focus rather is so much on earnings that the book value compounding gets pushed to the back?
No, I think it matters. I think, we're looking at stocks that have the most tangible book value opportunity of growth over the next couple of years. And those are, some stocks that we're recommending. So I think that's a piece of it. I think it matters. And I think we're going to see over the next couple of years, we're going to see better tangible book value growth, and we're going to see improved ROTCEs. And that helps your price to tangible book value valuation. We've done that regression a million times. So I think it matters. But I do think in a year where we're seeing improved EPS growth and slightly improved profitability, we are going to shift more towards PE. And so the question is always then, well, what's the right PE to put on that? I think my view is today in this environment, it's really hard for us to get back to that 14 historical PE multiple. I think structurally our industry is just different. We've got more regulatory headwinds. We've got higher expense headwinds, just with trying to invest in tech. The deposit, I think, cost, I think structurally kind of came undone with the cycle over 2023. So I think it's really hard to see us getting back to historical profitability levels and then historical PE levels. But does that mean that we can't, we're trading at 1.5 times book, 10, 11 times earnings today? I think in an environment where we're back to EPS growing at a 8 to 12% pace each year with a 1 to 120 ROE and kind of low teens ROE, why can't we be a 12 PE kind of industry? And that even feels cheap, probably some upside, but that feels right to me. That's about where our valuations and our price targets are shaking out today.
Yeah, it makes sense. And there's still a lot of, as you go downstream on liquidity, I feel like there's still a lot of lack of capacity of buyers relative to where we were pre-COVID, which, I think I'm optimistic that can improve and change, but there's still a long way to go there, which, can be a challenge. Well, this has been great, Catherine. Bank earnings obviously is set to kick off, so we appreciate you sharing your thoughts. I can't let you escape, though, without your top 1 or 2 picks for the next 12 months. Help us figure out how to make some money, and we'd love to hear what you have.
So one of the stocks that we upgraded in this NII report was Town. And part of it was I was trying to look at banks that, there's a lot of different ways you can think about best positioning for lower rates. And what I liked about Town was you kind of got everything. They've had a low cumulative loan beta because they've got a lot of CRE, and so you've still got a lot of back book repricing opportunity. So I think their loan yields are going to continue to go up even as rates go down. They also kind of had a middle of the range deposit beta, and so there's opportunity for that to come down. So your margin actually has some really nice expansion opportunities, both from loans and deposits kind of working at the same time. Their growth has been slow, but we think that's going to improve as you get to next year. They just did a small but all cash transaction that's about 6% accretive to EPS. So that's another add. And then they've got a big mortgage book that's under earning today. And so you've also kind of get the kicker of mortgage earnings improving over the next couple years. And so that's a stock that, I see 20% plus EPS growth in each of the next 2 years. And so with that, it's trading really cheaply on 2026 EPS. So that was why we upgraded Town. Another thing that we looked at in this report that I think is really important is it's easy to just look at liability sensitive banks, screen it, and say, all right, these are the banks that are going to have the biggest increase in EPS over the next 2 years because they're coming from such a trough. But some of those still are under earning, and some of those are coming from such an underperformance in profitability over the past couple of years that it's a big shift, but it's off of like a really low trough. And so some of my favorite stocks are actually ones that have done well in both cycles and have shown us their ability to grow at an above average revenue pace. No matter what interest rates are doing, it's just their ability to grow and kind of manage EPS and manage their business. And South State and Pinnacle are 2 banks that I cover that look really well in that kind of category. They've done well and outperformed both in the tightening and we think in the easing cycle. So those are 2 other stocks that I would highlight.
Love it. Yeah, we know the bank group's definitely always at risk for value traps, right? So you sometimes you do get what you pay for. But Catherine, appreciate you sharing your insights. Good luck this quarter, and hopefully we get a chance to speak soon.
Thank you. Thanks for having me. It was great to see you.